Hey, what's up guys? My name is Daniel Lopez with Invest in You Finance, and today we are going to be talking about the Backdoor Roth. Now, the Backdoor Roth is not actually an account. It's more of a move that you make between your IRA and your Roth IRA. So the way a Backdoor Roth works is you have to have an individual retirement account. And to have an individual retirement account, you will need to have a W-2 and have earned income. So I had an IRA when I was a lifeguard at 16 years old. I also contributed to the individual retirement account when I was working for my internships. I had 2 internships. So because I didn't have a 401k, I opened up an individual retirement account and would contribute, just small amounts of money into those accounts because my income was not that high. So I needed the money to pay bills and things like that. So I just contributed a small amount. However, so I do have an individual retirement account. And you also need a Roth IRA. So I know online everyone says, oh, you need to contribute the maximum amount, $6,000 to a Roth IRA. And that's like the headliner. So with a Roth IRA, you have tax-free money that is basically gonna grow tax-free inside this retirement account. The money is put in and it's taxed at that time pretty much. So like basically you open up a Roth IRA and you put money into it. Well, the money you put in, you're being taxed at the current rate of your income. So when people say, oh, you should put into a Roth IRA, it should be, you should put into a Roth IRA depending on your situation. Because I did not have a Roth IRA when I was making higher than like $100,000. Because for me, my whole purpose of having a 401k when I made that higher amount of income was to reduce that income to pay less taxes. If I'm in like the 35% tax bracket and I'm putting the max $6,000 in there, that $6,000 is being taxed at 35%. And I would rather wait until my income was lower to contribute to a Roth, because then the money that I'm putting in is taxed at a lower rate. So to get back to the Backdoor Roth, the Backdoor Roth is just a move. And that move is to basically get money from your IRA and then you transfer it to your Roth. So you deposit money here and then you transfer it over here. But the whole point of this strategy is there's 2 reasons why you'd want to do this. The first reason is a lot of one-line headliners don't tell you that in order to contribute to a Roth IRA, you have to meet an income requirement. You can't make, I believe it's over like 129,000 or 130. Go ahead and look it up. You'll see you can't make more than that amount of money to contribute to this account. If you make more, you're not allowed to. Or if you are, you can contribute like a fraction of that $6,000 based on your income up to, I think, you're gonna have to look this up, it's around $170,000. I can't remember off the top of my head. But up from like 129 to maybe 170, you can contribute a fraction of that $6,000 into your Roth account. So that's why it's important to get with a CPA, get with a tax advisor, have them do your taxes, and then they'll tell you, hey, this is how much you can contribute to your Roth IRA. Because they've calculated everything out. They said, according to your income, this is how much you can contribute. So that's one thing to consider, that not all people can contribute to the Roth IRA. If you make less, you can contribute. But if you make less, why aren't you going to contribute to your 401k to reduce your taxable income and save on taxes that way? For me, my whole goal was to retire early and become financially independent. And because of that, I knew that it was better for me to max out my 401k and reduce my taxable income, max out my HSA, reduce my taxable income. And when I was retired early, not working for earned income, I was going to backdoor the Roth IRA. So I just decided not to do a Roth IRA because I was going to do it later on. But it's good to know about these accounts. So if you make more than the $130,000 and you phase out, you can't contribute to the Roth IRA, what you can do is backdoor to the Roth IRA. The way you backdoor is you put money into an individual retirement account, and once you put it in there, you can transfer it to a Roth IRA. So that's one way to do it. Or if you already have an individual retirement account, because like for me, I was working as a lifeguard, or I was working as an intern. I didn't have a 401k, I had an individual IRA. So I put money in there, and then I bought, stocks, or I bought ETFs. So I have stock and ETFs inside my IRA. So I already have this account. I could backdoor to the Roth IRA. And what the internet or one-line Instagram posts don't tell you is that you also have to have a limit on your income to contribute to an individual retirement account if you want to deduct that contribution on your taxes. So you have to make $66,000 or less in order to take a deduction for that contribution. So when I was working as a lifeguard, I was not making $66,000. So if I contributed $1,000, I can reduce my taxable income by that $1,000. But like I said, if you make over that, like 6 figures or more, however much more, you can contribute to an individual retirement account. But if you have a 401k at the same time, there are limits when you contribute to your 401k and an individual retirement account. So you're gonna have to figure out how much you're gonna want to contribute if you're making over 6 figures, $130,000. So there are all these like rules and all these stipulations of what you can and can't do. So you're gonna want to look at all that before you decide ultimately. For me, when I was making 6 figures, making a lot of money, I was concentrating on maxing out my 401k, maxing out my health savings account, and not focusing on a Roth IRA or an individual retirement account, because I knew later on I can do that. Like now, I can roll over my 401k to an individual retirement account. So I can take all that money, roll it over into an individual retirement account, and then I could backdoor to a Roth IRA. And a backdoor is just, it's just a move that you're doing. But when you backdoor, you're moving money from your IRA to your Roth IRA. If you had a deduction because you contributed to your IRA and they reduced your taxes, when you backdoor, that money is going to be counted as income. So that year when you backdoor, you're gonna get like I don't know what form they're gonna send you, but you're gonna get a form that says you pulled out from your IRA, you're gonna be taxed on that amount. And it's gonna just be added to whatever income you have for the year. So if you backdoored $10,000 and you made $50,000, your total gross income is gonna be $60,000. And you're gonna be taxed on that amount. So to do a backdoor, you have to take that into consideration, the amount of taxes that you're gonna pay when you backdoor that money. So the point of this video is to talk about the backdoor. I mean, there's like all these rules, so you have to really know what you're doing with the taxes, how much money you're making, your income limits, and all that. I'm not a financial advisor. This isn't financial advice. This isn't tax advice. Please consult with your professionals. This is just for entertainment purposes only. I'm just sharing my story and what I've done. But what I would say is you can roll over whatever amount you're willing to basically pay taxes on. If you're willing to pay taxes on $5,000, you're in a lower income tax bracket, then you can roll over $5,000 worth of stock or $5,000 worth of cash to a Roth IRA and pay taxes on it. Once you pay taxes on it, then it's gonna grow tax-free in that account until you retire at age 59 and a half. So that's the benefit of the Roth IRA. The benefit is the money inside is growing tax-free. If I roll over my money from my 401k into an IRA, I'm not gonna do one lump sum rollover into a Roth. I'm gonna wanna space it out little by little, calculate, okay, this year, if I transfer 5,000, then I'm gonna be taxed this much. Then that 5,000 is gonna go in here to the Roth. From that point on, it's gonna grow tax-free. I'm gonna pull that out at 59 and a half. It will be not taxed. So the strategy here that I wanted to say is, right now, during a recession, we're not officially in a recession, but the numbers are pretty low. And let's just say right now, during a market correction where the market is down 10, 15%, some high growth stocks are down 50%. So if you have like an IRA with Facebook or any tech stock that's down significantly, 20, 30%, now would be a good time to move that stock, because you can move the stock. Let's say you have like 100 shares. You can move 50 shares of Facebook. You can move however many shares you want. The point is, the shares have dropped in price. What that means is you're gonna pay less taxes on this rollover. If you do 50 shares, let's just say that you wanted to transfer $4,000. You're like, I'm gonna transfer $4,000. I plan on doing this. Well, the market corrects. those shares, that Facebook price drops 30%. Now, instead of transferring $4,000, that amount just decreased. So because it decreased 30%, then you're gonna transfer a smaller amount of money, of shares. So I don't know if that makes sense, but basically what I'm trying to say is, if you move 50 shares, a year ago they were worth $4,000. Now those same 50 shares, let's just say they're worth $3,000. So now, instead of paying taxes on $4,000 because you rolled over the $4,000 of shares into a Roth, because we're in a correction, market downturn, recession, you're going to be paying less taxes on this rollover. Instead of paying taxes on $4,000, you're going to pay taxes on $3,000. So this is a strategy to use. Right now is a time to do an IRA backdoor Roth to a Roth IRA, because you're going to pay less taxes on the amount that's rolled over. And if you wanted to do that, of course, you have to make your own calculations. You have to look up, the rules and everything and figure out if it's worth it to you. My strategy was, when my income dropped, I was going to roll over my 401k to an IRA and then move money little by little to a Roth IRA. However much money I wanted to pay on taxes. If my taxes are, in the 10% bracket, 15% bracket, then I know, okay, I'm going to pay, if I move $1,000, that $1,000 is going to be added to my income. And am I willing to pay the 10, 15% upfront tax to get it over here? Probably so, compared to if you're in the 35% tax bracket. Or if you're in the 35% tax bracket, you calculate and do your own thing, but you're not going to want to roll backdoor Roth, because if you make $100,000 and you backdoor Roth $10,000, your income's now going to be $110,000. So you're going to be taxed in that tax bracket of $110,000. So that's probably not a good time to roll it over. But if you want that tax-free money and you make over $175,000 or however much money that you can't contribute to a Roth IRA, then you can just contribute to an IRA, put that money in there, and then roll it over. So the backdoor Roth is a good strategy to use, but it does get confusing. It does get complicated because of all the rules and all that stuff. I haven't done any of these yet, because in my other videos, like I said, I like the funds that my 401k is in right now. So that money is just growing. That money's growing at a good, rate of return. So I'm happy with it. I haven't rolled it over yet. I'm still weighing out my options of what I want to do. If I want to roll over a certain amount every year, pay taxes on that. So we'll see what I do. But the whole point of the video is, right now is a good time to lateral move any stock or shares that you want to, because you're moving them at a lower price, and therefore you're going to be taxed at a lower price. When you move, for the example, the 50 shares, so you move 50, you're going to have 50 left. So you move the 50, now you have the 50 shares. You moved $3,000 because the price went down, and the value in here is now $3,000. Well, you know that eventually the value is going to go back up. So you got to save $1,000 in this particular situation because the price dropped $1,000. Instead of paying taxes on $4,000 because the price of the stock was up, now you're going to pay taxes on $3,000. It's still 50 shares in both cases. 50 shares to 50 shares. The shares don't change. It's just how much those shares are worth. And by having shares that are worth less because market's down, at that point, it's probably a good opportunity to weigh out your options to see whether you want to do a backdoor Roth or not. So hopefully this didn't go over your head, guys. Hopefully you start watching other videos, getting more familiar with the terminology, getting more familiar with these accounts. And once you hear this over and over and over, then it'll start making more sense to you. And you could just Google Roth IRA, individual retirement account, rules, when can I get a deduction when I contribute to an IRA, when am I not allowed to contribute to a Roth IRA because I make too much, but you can contribute to an individual account. If you make more than $66,000, you could contribute. However, it won't be a deduction on your taxes. If you make $100,000, you can contribute to an individual retirement account. It won't be a tax deduction like someone who makes $66,000 or less. It'll just be a contribution. Then from there, if you want to, you could roll it over to a Roth IRA at any point in time later on or whenever. So this is what a backdoor Roth is. And there's like a backdoor, I think they call it a conversion ladder. So you're basically converting that money from a period of time. Another reason like you could do this or would want to do this is to avoid, in an IRA, here's another thing that everyone needs to know about. You have required minimum distributions. That means when you get to a certain age, you have to pull this money out. Like you have to start pulling money out. The government's going to say, hey, you need to pull the money out. And when you pull it out, yes, because you got the tax break when you put the money in. When you pull it out, you're going to be charged taxes. So another strategy that someone, let's say at 60 years old, might want to do is do a backdoor Roth. Because from 60 to, I believe it's 70 or 72, at 70 or 72 years old, you are required to take out minimum distributions from an individual retirement account. It's like a small percentage of the account value, or every year they tell you you have to pull out this much money. So if you retire at 60 years old, you have 10 to 12 years to convert all this money to a Roth, so that way you can avoid the required minimum distributions, the RMDs. So that would be a reason why you would want a backdoor. And when you retire around at 60 years old, your income is going to be less. So that would be a good opportunity to transfer money from your individual retirement account to a Roth IRA. That transfer is going to be at whatever income you're at for retirement. So just think about that. You hypothetically, if you had all this money in here, you can have that money divided by 10 years, because that's when you're going to start having to pull out the required minimum distributions. You can, over the 10 years, divide that up, transfer it to a Roth little by little. But meanwhile, you're living off, your retirement funds. Because another rule with the Roth IRA, you have to have the money in there for 5 years before you can pull it out. So like the first year, you can't contribute year one and then pull that same money out like within 5 years. So there's like a 5-year rule in the Roth IRA. So you're going to want to put all your money in the Roth IRA, and then over that 10-year period from the time you were 60 years old to 70 years old, you're going to transfer the money and pull out the Roth IRA money once you're like 70 years old. So those are just strategies that you can think about doing, and ultimately you're gonna have to calculate whether it's worth it for you or not. But anyways, guys, like I said, so many rules, so many stipulations. Go on the internet, check it out, see what you think, make calculations, get a piece of paper, write it down, and just figure out what's best for you. When you're trying to do financial independence, retire early, some people just don't even contribute that much money into their retirement accounts because they might not make enough money to max out their 401k. And what they will do is just contribute the minimum amount to get the 401k match from their company, which is typically like 4 to 5%. They'll just put 4 to 5% in their retirement account. They won't worry about the retirement account. They'll worry about the funds to make sure that they choose the best fund inside the retirement account, but they're not really, worried about that account. What they're worried about is their individual stock account, because when you retire early, you have to have an individual stock account to pull out money as if it were your retirement account. So that way you wouldn't get charged penalties on it. So for someone who's looking to be financially independent and retiring early, you're definitely going to want an individual stock account, and that's going to act as if it were your retirement account. So all the money that you didn't contribute to any of your retirement accounts, you're going to put in there. So a lot of people in the FIRE community, they put as much income as they can into their individual stock account, knowing that that's the money that they're going to live on, because they can't pull out from their 401k without getting penalized. And they know that the money that's in their 401k can't be touched until they're 59 and a half. So that's just something to think about if you're thinking about retiring early. And hopefully this, like I said, it's not too much information. You guys are smart. You guys will do your research. You guys will check it out on the internet. And, these are just some strategies that you can use and you can look into. Anyways, guys, I appreciate you guys watching. Thank you so much. Please like and subscribe. Check out my other videos, and I'll catch you in the next one. Peace.